What is a Bitcoin?
What is Bitcoin?
What backs a Bitcoin?
Bitcoin now above $960. Are you that much of a believer?
What money is.
It's called cryptocurrency. Bitcoin. Bitcoin is digital currency and computer software.
You see, I just want your care.
Money is one of the most significant inventions in human history. It powers societies, drives innovation, and fuels both collaboration and conflict. Over centuries, money has evolved alongside human civilization, reflecting our progress, aspirations, and sometimes our darker impulses. From trading salt to coding digital currencies, the journey of money has been nothing short of revolutionary. As we stand at the precipice of a digital era, one question looms large. Is Bitcoin, the so-called magic internet money, the end of money as we know it? To understand this monumental shift, we must first revisit the origins of money itself, a story as old as human interaction. The birth of money. In prehistoric societies, transactions were simple. Barter systems allowed people to exchange goods and services directly. If one tribe member needed meat and another had surplus firewood, they could make a deal. This system, however, was limited. It required a double coincidence of wants, meaning both parties needed to desire what the other offered simultaneously. As human communities expanded and trade grew complex, the need for a universal medium of exchange became apparent. Enter commodity money, items that held intrinsic value and could serve as standardized currency. In various parts of the world, commodities such as salt, cacao beans, whale teeth, and even yak dung became early forms of money. These items met 5 essential criteria. They were scarce, recognizable, divisible, durable, and portable. Commodity money worked well for a time. However, as societies became more interconnected, these forms of money revealed limitations. Commodity-based currencies like grain or salt were vulnerable to spoilage or overproduction, destabilizing economies dependent on their value. A more reliable and scalable solution was needed. The first revolution, in this situation, around 2,500 years ago. Metal coins emerged as a game-changer in what is now Turkey and China. These coins retained the advantages of commodity money while addressing its flaws. Made from durable metals like gold and silver, coins were uniform, portable, and resistant to degradation. Coins also introduced a groundbreaking concept: centralized control of currency. Kings and emperors, by minting coins, established the first links between political authority and money. Citizens trusted these coins, assuming their rulers wouldn't cheat on the metal content, a trust that was often misplaced. However, centralization brought its own problems. Rulers frequently debased the currency by reducing the precious metal content to fund wars or build lavish palaces. Over time, coins lost their value, causing inflation and economic instability. Yet, the innovation of coins paved the way for a broader economy, enabling trade across vast regions and fostering the growth of market systems. The advent of banking. As commerce flourished, the limitations of carrying heavy metal coins became evident. So, the world entered into the concept of paper money, a significant leap in the evolution of currency. In the 15th century, European merchant families like the Medicis began issuing promissory notes. Essentially, IOU documents backed by gold or silver. The Medici family didn't just trade goods, they traded trust. Their notes became so widely accepted that they essentially invented a form of private currency. Soon, other merchants and goldsmiths followed suit, creating a thriving banking system. Goldsmiths, in particular, played a pivotal role in the birth of modern banking. Initially, they acted as safekeepers, storing coins for individuals in secure vaults. Over time, they realized that most deposited coins remained untouched for long periods. Seizing this opportunity, they began issuing loans against these deposits, charging interest. Eventually, these loans didn't even require physical gold. The goldsmiths issued receipts, early paper money for the gold they held, and these receipts circulated as currency. This practice marked the beginning of fractional reserve banking, where banks lend out more money than they physically possess. But that's not the kind of money we use today, is it? Yep, you guessed it. Another big shift happened, shaking things up once again. The rise of central banking, the proliferation of private paper money created chaos without centralized oversight. The value of currencies fluctuated wildly, undermining trust in the financial system. Governments, recognizing the dangers, stepped in to establish central banks. In 1694, the Bank of England became the first official central bank, created to fund wars against France. Its monopoly on issuing paper money marked a turning point. The government now controlled not only the currency but also the economy. In the United States, the creation of the Federal Reserve in 1913 centralized monetary policy. The Fed aimed to stabilize the economy by controlling the money supply, a task fraught with challenges. During the Great Depression, for example, the Fed had to print vast amounts of money to reignite economic activity, leading to President Roosevelt's controversial decision to confiscate citizens' gold in 1933 by severing the link between money and gold during the Nixon administration in 1971. The United States dollar became a fiat currency, backed solely by trust in the government. This shift underscored a fundamental change. Money was no longer a tangible asset, but an abstract representation of value, subject to manipulation by those in power. A double-edged sword. As money evolved, so did its role in society. It became both a tool for progress and a weapon of exploitation. While the global financial system has enabled unprecedented economic growth and connectivity, it has also deepened inequalities and perpetuated corruption. Banks and governments often prioritize profits over people, extracting wealth from the masses and concentrating it among the elite. This imbalance became glaringly apparent during the 2008 financial crisis, an event that laid bare the vulnerabilities of traditional financial institutions. The crisis was years in the making, fueled by historically low interest rates and lax lending standards. In the early 2000s, the Federal Reserve slashed rates to stimulate economic recovery from the dot-com bubble. Corporate accounting scandals, and the aftermath of the September 11 attacks. This made borrowing cheap, spurring a housing boom as individuals rushed to buy homes. Even those with poor credit histories, subprime borrowers, were offered loans, often for properties well beyond their means. These subprime loans were repackaged into seemingly low-risk financial instruments like mortgage-backed securities, which were sold to investors worldwide. However, this foundation of debt was anything but stable. By 2006, cracks began to appear as home prices started to decline. Adjustable rate mortgages reset at higher rates, leaving many borrowers unable to afford payments. Homes lost value, trapping owners in properties they couldn't sell without incurring losses. As foreclosures mounted, the financial institutions that held these mortgage-backed securities found themselves saddled with trillions of dollars in toxic assets. Subprime lenders began to collapse, and by mid-2007, the financial system was on the brink. The collapse gained momentum in 2008. Bear Stearns, a major Wall Street firm, fell in March, followed by Lehman Brothers in September, the largest bankruptcy in United States history. Banks stopped trusting each other, freezing credit markets globally. The resulting Great Recession wiped out millions of jobs, homes, and life savings, devastating ordinary people while governments scrambled to bail out failing corporations. Central banks printed trillions of dollars to stabilize economies, but this response reinforced distrust in traditional financial systems. This era of turmoil exposed the flaws of centralized finance, leaving a void that demanded innovation. The collapse of trust in traditional systems set the stage for the rise of alternatives, a decentralized, transparent, and deflationary digital currency that promised to rewrite the rules of money. Yes, we're almost there, ready to meet the true hero of the story, Bitcoin. The Digital Disruptor, in 2009, amidst the aftermath of the financial crisis. An anonymous figure or group known as Satoshi Nakamoto introduced Bitcoin. Nakamoto mined the first block, known as the Genesis block, containing the first 50 Bitcoins, described as a peer-to-peer electronic cash system. Bitcoin was revolutionary. It eliminated the need for intermediaries like banks, enabling direct transactions between individuals. Bitcoin's underlying technology, blockchain, was equally groundbreaking. It created a transparent and immutable decentralized ledger, ensuring that no single entity could control or manipulate the system. Unlike fiat currencies, Bitcoin's supply was capped at 21 million coins, protecting it from inflationary pressures. Its open-source protocol ensures transparency, meaning anyone can review, use, or contribute to the code. Nakamoto's anonymity and the decentralized nature of Bitcoin raised both curiosity and skepticism, yet it has proven resilient over the years. From magic internet money to financial revolution, initially dismissed as magic internet money, Bitcoin has since gained legitimacy as a store of value. Akin to digital gold, its supporters argue that Bitcoin democratizes finance, giving individuals control over their wealth without relying on banks or governments. Critics, however, highlight its volatility and environmental impact, questioning whether it can truly replace traditional money. Despite these concerns, Bitcoin has sparked a broader conversation about the nature of money, trust, and power in the digital age. The concept of Bitcoin rests on the foundation of decentralization, a radical departure from the centralized control wielded by governments and financial institutions. Unlike fiat currency, where value is influenced by policies and subject to manipulation, Bitcoin operates as an open-source network where every transaction is transparent and immutable. This is achieved through blockchain technology, a publicly distributed ledger maintained by a network of computers called nodes. These nodes collectively verify transactions, ensuring the system remains secure and resistant to tampering. At its core, Bitcoin's blockchain records every transaction ever conducted, creating an unalterable history. To participate, users need a digital wallet, which contains a pair of cryptographic keys, a private key and a public key. The private key is like the PIN for your bank account. It grants you access and control over your Bitcoin. The public key, on the other hand, acts as your wallet address, like a bank account number, for receiving funds. Let's break this down with an easy example. Imagine you're sending a postcard. The public key is the recipient's address written on the postcard for everyone to see. It's where the funds are sent. The private key, however, is like the key to the mailbox, ensuring only the intended recipient can access the postcard once it arrives. Without the private key, no one can open the mailbox or access the Bitcoin. Bitcoin's decentralized system relies on miners, who act as both the system's accountants and its minters. These miners solve complex mathematical problems to validate transactions and bundle them into blocks, which are then added to a continuous chain of prior blocks, hence the name blockchain. This process is not only crucial for maintaining the ledger's integrity, but also for creating new Bitcoin. Miners are rewarded for their work with freshly minted Bitcoin, which ensures a predictable and limited supply. This brings us to one of Bitcoin's most unique features, its finite supply. Unlike fiat currencies, which central banks can print in unlimited amounts leading to inflation, Bitcoin's supply is capped at 21 million coins. This scarcity is why Bitcoin is often called digital gold and is valued as a deflationary asset. Over time, as more coins are mined and the supply diminishes, Bitcoin's scarcity is expected to increase its appeal as a store of value. Additionally, Bitcoin provides a level of privacy. While traditional banking systems require extensive personal information, Bitcoin transactions are pseudonymous. Users are identified only by their wallet addresses, offering privacy without compromising transparency. For instance, you might see a transaction on the blockchain showing that wallet A sent XBTC to wallet B, but without revealing any personal details of the individuals involved. Lastly, Bitcoin is globally accessible. It transcends borders and allows anyone with an internet connection to send and receive funds instantly, breaking down the barriers of traditional financial systems. This inclusivity positions Bitcoin as a groundbreaking tool for democratizing access to financial services worldwide. Unlike traditional currencies that can be printed at will, leading to inflation, Bitcoin operates on a deflationary model. This characteristic has drawn the interest of investors, tech enthusiasts, and even governments exploring blockchain's potential. However, Bitcoin's limited supply also raises questions about its long-term viability as a global currency. Once all 21 million coins are mined, the network will rely solely on transaction fees to incentivize miners, a fundamental shift that could reshape its economic dynamics. Bitcoin's emergence marked the birth of cryptocurrencies, a revolutionary shift in how people perceive money and transactions. Cryptocurrencies beyond Bitcoin. Bitcoin may have set the stage, but it's far from the whole story. The cryptocurrency universe has expanded into a vibrant, chaotic, and utterly fascinating ecosystem of innovation. If Bitcoin is the godfather of this movement, then the thousands of digital currencies that followed are its rebellious offspring, each carving out its unique identity in this brave new world. Take Ethereum, for instance. Dubbed the world computer, Ethereum didn't just follow in Bitcoin's footsteps, it shattered boundaries. By introducing smart contracts, self-executing agreements coded onto its blockchain, it opened the floodgates to an era of decentralized applications. Imagine buying a house, trading stocks, or securing loans, all without middlemen or red tape. That's the promise Ethereum delivered, and industries from real estate to gaming have been transformed as a result. But Ethereum isn't alone in this race. Remember Solana, the Ethereum killer, boasting lightning-fast transaction speeds and minuscule fees. It has become the darling of decentralized finance platforms and NFT marketplaces. Then there's Cardano, a blockchain with a mission, solving real-world problems with an eco-friendly approach. From identity solutions in Africa to securing supply chains globally, Cardano is rewriting the playbook for blockchain's potential. And who could ignore Ripple? Despite its ongoing regulatory battles, Ripple continues to dominate cross-border payments, positioning itself as the bridge between traditional finance and the crypto world. With partnerships spanning major financial institutions, it's a heavyweight contender in the blockchain revolution. Meanwhile, the rise of meme coins like Dogecoin and Shiba Inu adds an unexpected twist to the crypto narrative. What started as jokes quickly evolved into legitimate market players, proving that in the world of cryptocurrency, the line between serious innovation and internet culture is razor thin. Challenges in cryptocurrency adoption. Despite the promise of a financial revolution, cryptocurrencies face a path to mainstream acceptance that is fraught with challenges, from regulatory battles to security concerns. The road is as bumpy as it is intriguing. If you thought crypto was all about innovation and endless possibilities, think again. There are serious challenges that could shape its future in unexpected ways. Let's start with the regulatory chaos. Governments worldwide are in a tug-of-war over how to classify and control digital assets. Are cryptocurrencies securities, commodities, or currencies? The answer depends on who you ask, and the lack of global consensus is a nightmare for investors and businesses. Regulatory crackdowns, like those in the United States or China, send shockwaves through the market, creating uncertainty and slowing adoption. And then there's the elephant in the room, volatility. Cryptocurrencies are infamous for their wild price swings. Bitcoin, the poster child of crypto, has seen its value rocket from a few $100s to tens of thousands and back down within months. For thrill-seeking traders, this is a dream, but for everyday users and businesses, such instability makes cryptocurrencies a tough sell as a reliable means of exchange or store of value. Security woes further complicate the picture. While blockchain technology itself is robust, the platforms and wallets that support crypto transactions often fall prey to hacks and scams. High-profile incidents, like exchange breaches and phishing schemes, have eroded trust among skeptics and even some enthusiasts. It's a stark reminder that technological innovation must be matched by advancements in security infrastructure. Traditional financial institutions haven't exactly rolled out the red carpet for crypto either. Banks, reliant on transaction fees and asset custody for revenue, view cryptocurrencies as direct threats to their business model. Why pay fees for a middleman when you can send money directly via blockchain? The answer is clear, and it's forcing banks to rethink their strategies. But the tide is turning. Major players in finance are cautiously stepping into the blockchain world, from developing their own digital currencies to investing in crypto startups. Banks are signaling a shift from resistance to reluctant embrace. Blockchain's potential to streamline operations and cut costs is simply too big to ignore. Meanwhile, central banks are crafting their own response to the crypto revolution: central bank digital currencies. These digital versions of traditional money promise the speed and transparency of blockchain with the stability of fiat currency. China's digital yuan is leading the charge, while the United States and European Union are ramping up efforts to avoid being left behind. Real-world applications of Bitcoin. Despite these concerns, Bitcoin's potential extends beyond currency. One of its most prominent applications is in international remittances. Traditional remittance services, such as Western Union, often charge high fees and take days to process transactions. Bitcoin, on the other hand, enables faster and cheaper cross-border transfers, providing a more efficient solution for millions of migrant workers sending money to their families. Another important use case for Bitcoin is as a store of value, often referred to as digital gold. Bitcoin serves as a hedge against inflation and economic instability. In regions with volatile currencies or economic turmoil, individuals and businesses increasingly turn to Bitcoin as a reliable alternative for preserving wealth. Bitcoin has also found a place in e-commerce. Companies like Overstock and Expedia accept Bitcoin payments, bypassing traditional credit card processors and their associated fees. This not only reduces costs for businesses, but also provides a convenient option for tech-savvy consumers. Moreover, Bitcoin's blockchain technology facilitates the creation of smart contracts. These self-executing agreements operate without the need for intermediaries, automating processes such as payments, rentals, and legal settlements. This application highlights Bitcoin's potential to disrupt industries beyond finance. Perhaps most significantly, Bitcoin is rewriting the rules of financial access. Imagine millions in developing countries, long excluded from traditional banking, suddenly empowered to connect to global markets. With just a smartphone and an internet connection, they can now trade, save, and grow, breaking free from the barriers that once held them back. It's not just a currency, it's a catalyst for change, unlocking opportunities that were once unimaginable. The future of Bitcoin. The road ahead for Bitcoin is as electrifying as it is uncertain. Will it rise as the backbone of a decentralized global economy, or will it falter under the weight of its own volatility? As the pioneer of cryptocurrency, Bitcoin stands at the crossroads of boundless potential and relentless skepticism. With the stakes higher than ever, the next decade promises to transform the very foundation of finance, or shatter expectations entirely. The revolution is just beginning. One of the biggest questions surrounding Bitcoin is scalability. With its blockchain currently processing only 6 to 8 transactions per second, Bitcoin lags far behind traditional payment systems like Visa, which can handle thousands. This isn't just a hiccup, it's a roadblock. But hope lies in the Lightning Network, a second-layer solution designed to turbocharge Bitcoin's transaction speeds and lower fees. While its adoption has been slower than expected, this technology holds the key to making Bitcoin more accessible for everyday use. From buying a cup of coffee to enabling swift international trade. Regulation is another battleground that will define Bitcoin's future, as I already told you. As governments and financial watchdogs scramble to keep pace with this digital disruptor, the cryptocurrency is caught between the need for legitimacy and the threat of over-regulation. On one hand, approvals like Bitcoin exchange-traded funds have opened doors for institutional investors. signaling growing mainstream acceptance. On the other, unresolved debates about classification, taxation, and cross-border policies could either pave the way for a financial revolution or smother Bitcoin under a web of bureaucracy. Meanwhile, Bitcoin's allure as digital gold is becoming harder to ignore. Major players like Tesla and Square have already added Bitcoin to their corporate treasuries, treating it as a hedge against inflation and economic uncertainty. This shift is reshaping Bitcoin's identity, not just as a currency, but as a powerful asset class that could rival traditional financial instruments. The more businesses and institutions embrace Bitcoin, the closer it comes to becoming a permanent fixture in global markets. But even as Bitcoin climbs to new heights, it faces scrutiny for its environmental impact. Critics slam its energy-intensive mining process as unsustainable. Though proponents counter that renewable energy adoption in mining is on the rise, future advancements in mining efficiency or a transition to greener practices could quell these concerns, ensuring Bitcoin aligns with a world increasingly focused on sustainability. Yet, amid all its achievements, Bitcoin's core principle, decentralization, faces an existential threat. As mining power and coin ownership concentrate in fewer hands, questions arise about the network's integrity and resistance to manipulation. This shift challenges Bitcoin's foundational ethos, and its community must address these imbalances to maintain its democratic spirit. Looking ahead, Bitcoin's halving events, which systematically reduce the rate of new coin creation, will continue to play a pivotal role in its price dynamics. Historically, these halvings have triggered bullish trends, and with the latest one in 2024, many believe Bitcoin could soar to unprecedented levels. However, its value remains as volatile as ever, poised to either skyrocket or plummet. Depending on global sentiment and market forces, Bitcoin's future is anything but certain, but that's what makes it so thrilling. Whether it evolves into a cornerstone of decentralized finance or settles into a niche as digital gold, its impact on the world of finance is undeniable. As the world watches, Bitcoin's journey promises to be one of the most captivating narratives of our time. Will it fulfill its destiny as a financial revolution, or will it falter under the weight of its challenges? Only time will tell. But one thing is clear, the Bitcoin story is far from over. But can Bitcoin, with all its potential and pitfalls, ever truly replace traditional money? The end of money or the beginning of a new era? Proponents say it's the dawn of a decentralized financial utopia. No central banks, no inflationary policies eating away at your hard-earned savings. Just a digital asset, finite in supply, quietly revolutionizing how we exchange value. Sounds idyllic, doesn't it? But hold on. Critics argue that Bitcoin is too volatile, too unpredictable, and far too niche to dethrone the dollar, euro, or yuan. After all, can you imagine paying for your morning coffee with something whose value could spike or tank before you take your last sip? Traditional money may have its flaws, but its stability keeps the wheels of commerce turning without giving anyone a heart attack over breakfast. And let's not forget the practical hurdles. Governments won't just sit back and let a decentralized asset usurp their carefully maintained monetary systems. Regulations, taxes, and outright bans. Bitcoin faces an uphill battle. Yet, for every obstacle, there's an innovation, layer 2 solutions, smart contracts, and integration into mainstream financial services. It's as if Bitcoin thrives on the challenge. So, what's the final call? Is Bitcoin the next logical evolution of money, or is it destined to remain a speculative asset, a digital gold rather than a transactional currency? Perhaps it's neither, or maybe, just maybe, it's both. As we peer into the murky future of finance, one thing is clear: the world of finance will never be the same. Bitcoin and its successors have opened the door to a new era of innovation, challenging the status quo and redefining what money can be. In fact, it's barely begun. But for now, the question lingers. Will Bitcoin replace traditional money, or will it simply redefine what money means? Only time will tell. So, Let's wait and see the game of currencies for now. Who knows? Maybe Bitcoin will moon, or maybe we'll all be trading cabbages in the next financial crisis. Whatever happens, money will keep surviving in one form or another,